Hello, friends. Welcome to this special episode. We will talk about some investor behavior uh, topics in this particular episode, and what we will discuss is essentially how things can look extended or a sort of a very strong trend that has formed, but when we compare it to history, uh, it may not be the same. So let's take a look at this current chart. This is BSE Sensex. Um, since COVID, Sensex has gone from nearly 26,000 to 80,000 in just over 4 years. Fantastic, fantastic returns. Almost more than tripled actually from this bottom, almost doubled from pre-COVID levels. And there is a lot of talk in the market about market have gotten very extended. We will have a great crash. Uh, this has never happened before. Uh, People who are sitting outside, not having not invested, are saying, you know, don't be in the market right now. Uh, then once the market will crash, only then you should get in. All that narrative is on, and it has been on for the last many years now. There was a brief pause from October 21 till about 18 months, and then the market restarted again. This was when this was happening post COVID. The same narrative was going on that COVID has just come. It has destroyed all supply chains. All the many industries have lost demand. This is not going to sustain. If you remember 2021, the entire narrative was this, that this is a unbelievable and a fictitious rally, and it has no legs. That rally 3 years later has almost doubled. People who did not believe the rally then are not believing the rally now, and they're sitting outside. What have they lost? They've lost a significant bull run of this particular decade, because bull runs like this don't come every other year. They are spaced out by a large amount of time, and I'll show you that. So trying to time the market and saying that no, I think the market is very extended, so I will wait. That waiting can happen. I don't know. I mean, in Japan, people waited like 20 years before the bubble popped, and the same could happen anywhere else also. It is all about how much liquidity is flowing there, what is the kind of growth that country is going through, and there need not be a case of a correction. So just given that chart, I mean, how many of you were thinking that we have a big bull run? Please comment below, and the later on what data I'll show you, you may change your comments later on. So it isn't a it isn't a bull rally of any gigantic proportion. Let me explain, using this next chart, which is spanning the last let's say about 40 years. And we had two massive rallies. So we had one rally from 1988 to 1992, and then we had 2003 to 2008. And now let's say we are having this current rally. And you may say they look somewhat similar in terms of the extent of the move made. Now let's take a closer look at these two previous mega bull runs. So 1988 to 1992, Harshad Mehta bull run, the uh, situation was that it exploded in terms of the participation of the people. So still then, the common man, the average retailer, was not so clued into the market. And Harshad Mehta movement of this bull run, it just sucked in everybody into the markets. There were huge number of IPOs. People were very involved with the market. Stocks went up like crazy, and that really started the equity culture in the country. Once you get involved in the market, even whether you made money or you lost money, you are now educated in the market. So there, maybe somebody, most of the people paid a lot of learning cost in that period, and then the next few decades they use that learning to really compound wealth. So don't look at the short term impact of such events. These events have very, very long term impact on the entire stock market system, on participation, on institution building. It is only after this that the whole concept of national stock exchange came together. It is only after Harshad Mehta bull run that people started to think, the regulators, they started to think about that we should have more transparency, we should have more compliance, we should have a online trading system, there should be lesser brokerages, it should be easily accessible to everybody across the country. So many things you can imagine came out of the Harshad Mehta bull run period. It lasted for about 4 years. Sensex moved from around 400 rupees, 400 index, to about 4500 index in 4 years. Can you imagine sitting today that even if you took the Nifty bottom of COVID at 7500 odd, and in 4 years, that is 2024, it could have been at 75,000 or even more. It is that kind of a crazy run where absolute returns were 1000%, 11 times on the index, CAGR of 81% in these 4 years. So it was like a bull run like nobody's ever seen, right? And there is nobody to say that it can't happen again. Okay, so you could have created generational wealth in that bull market. Now let's explore the impact of this rally in today's context. So if we see in today's context, uh, if you are doing, let's say, 25,000 SIP per month, and you had a duration of 4 years, and you got a XIRR of 92% by, if we were to imagine that that kind of a thing could happen today, within 4 years, your 12 lakhs invested using SIPs reached almost 60 lakhs. If you were investing a lakh rupees a month, 48 lakhs invested in those 4 years became 2.4 crores in just 4 years of time period. That is the kind of bull run that ensued at that point of time. So if index did really that well, you can't really imagine what kind of stocks performance was there. So just for example, ACC was one of the leading stocks at that time. And in 2 years' time, ACC went up 53 times, a CAGR of nearly 500%. So Sensex went up 1000%, ACC went up 5000%. And if you were leveraged on this, people used to do badla and forward trades. You cannot imagine the kind of wealth that got generated in that time period. Second major bull run was 2003 2007. This was pre global financial crisis bull run where all emerging markets were running like mad. This lasted for about 4.7 years. Absolute return of 615%. Capital on index went up 7 times. So imagine 7,500 of COVID in nearly 5 years. If it goes to 50,000 Nifty, that would be the kind of move that has happened in those years. CAGR of 52%. Sensex starting at nearly 3,000, ending at nearly 21,000, and just continuous up with some periods of correction. This was actually the 2004 where BJP lost some ground, and these were normal corrections on the way till the bubble popped in 2008 globally on this. Again, if you were to see the kind of wealth that was made, 25,000 rupees SIP invested for that period of 4.5 years, 13.75 lakhs you would have invested, and value was almost 40 lakhs. If you invested 50,000, and value of 75 lakhs, and 1 lakh per month would have yielded you 1.5 crores within a metro. So you can see that there will be concentrated amounts of rallies within a short period of time, but spaced out by decades. It will not happen every other year, every 5 years or so. And you cannot predict when it will happen. You cannot predict this. Nobody knew in 2003. I remember I was into broking at that time from 1996. And after 2000 bubble of dot-com crash, we had virtually no work. For 2 years, we were sitting idle in the office. 2001 was completely like that. 2002 was completely like that. And I was on the verge of giving up the business. And I had started a BPO business on the side to make the bills run. And it was amazing to see how out of nowhere a rally started. And of course, during this initial couple of years, nobody realized that this is the kind of eventuality of this rally, and that kept extending, and it made you into this huge wealth creator over that period of time. Again, if index did so well, how did the stocks do? So there were stocks like Unitech, for instance. You can't even imagine the kind of gain that was possible on that. It did a 374% CAGR over 4 years, 1.6 lakh 50, 1.6 lakh percentage of gain. So almost you can say if 1 lakh rupee was invested, it became 17 crores in a matter of 4 years. That is the kind of huge gains were seen on some of the stocks. And the rally happened for 3 4 years, and then it popped, and the smart got out by the time it was coming off, and virtually anybody who was holding the bag till the end virtually lost all the gains, right? So I mean, it came back from nearly 400 rupees to almost zero point 0.4 rupees. And this will happen from time to time in many of the bull runs. Wealth will get generated and wealth will get destroyed. So nobody can really predict or exactly predict when a fierce bull market may rise. Now let's see the current situation where we had this nice gradual growth happening over 2013 to 2020 period. And imagine if COVID had not come, maybe the same trajectory could have continued as it is right now. COVID came, the world was changed, a lot of systems changed, people were exposed to the market because they had a lot of time, and this bull rally started after that. If you were to just remove this period of action here, we are pretty much going in a same path of, the same, you can say, angle of the tangent here. So Nifty right now has done 31% CAGR in 4.5 years, which is phenomenal. I mean, it is an amazing run from this bottom. From this bottom, when I calculate, it is a 31% CAGR. But the previous bull runs have been extremely superior. 81% CAGR in Harshad Mehta bull rally, 52% CAGR in pre-GFC rally. Both lasted 4 to 4.7 years. We are already at 4.5 years. So from a timing point of view, we are in the ballpark of where the previous bull rallies started, but we are nowhere near the kind of returns the past rallies have made. So if we were to, let's say, project that in case this rally has more legs and we are not ending in 4 years, we may end in 8 years. Okay, even a 15% overall CAGR will take us within 4 years to a 70,000 Nifty level. A 30% CAGR, sorry, a 30% CAGR will take us to a 70,000 Nifty level. A 40% CAGR will take us to a 95,000 level, and a 50% CAGR over 4 years will take us to 1.25 lakhs on the Nifty. That is the kind of return. And for 15%, you will reach somewhere near 43,000 on this scale. Of course, there can be many hiccups on the way, but this is the projection for that kind of return, which is possible given we have had past instances. You cannot say, I mean, nobody in Japan knew what is going to happen in the 80s, but money kept pouring into Japan, and the market had no other choice but to rise. When does the market rise? When liquidity comes into the market and people start investing. Even though you may say market is overvalued, stocks are not worth what they are priced at, but money is still pouring in because you are the only few country left in the world where some decent growth is coming. You have demographics. Let's assume, for instance, in the next 4 years, the world has a very different view of India, what it has had, or even domestically, people feel that uh, because of this last 4 years of reasonable and consistent gain, there is more money to be pumped into the market. Let's say more and more money comes to the market. What will happen? Index funds will continue to rise. There will be more and more people buying index funds. What will happen? When the index fund manager receives funds, he has no option but to go out and buy index stocks. Stocks go up. When you put money into a mutual fund, the mutual fund manager has no option but to go and buy more stocks. Stocks go up. When you are running a one of the fastest economies in the world with stable inflation, low interest rates, all the foreign money wants to get into your market also. And what does that does? Stocks go up. So it is a function of what is the narrative, what is the liquidity that comes into your country, and that will determine where the stocks will go, not because they are 15 times price earnings or 25 times price earnings. So these are the kind of moves that are possible over a period of time, and you cannot imagine that this kind of a rally, uh, you can't say that this kind of a rally cannot happen. It can happen, it may not happen, that's a separate matter, but it can happen. So both uh, bull markets of the first and second kind uh, lasted for about 4 years. This is about one-fifth of the total period. So there are only 20% of the time you really have fierce markets. Rest of the time it will be gradual up or some down years. The main lesson that you want to derive out of this is you are not, you know, you're not doing yourself any big favor by trying to time the market. Because what happens is that our mind has a lot of, human mind is filled with, let's say, recency bias. Now, let's say you have 2 years where nothing is moving and you have stock X lying at 10 rupees, stock Y lying at 50 rupees. Now, suddenly they become 20 and 100 because, the rally has started and, you know, suddenly there is focus on those stocks and they double within a matter of, let's say, a month. Now you've been, watching this for 2 years that this stock was at 10 rupees or the stock was at 50 rupees, and it was said by most experts that this is fairly valued. Now suddenly they have doubled. The businesses have not doubled overnight. So now you get the feeling that, no, no, these stocks are very expensive. They have doubled from where they were just recently, and I can't be buying this. Then what happens? That 20 rupee stock which has just doubled will go to 100. That 50 rupee stock which has just doubled to 100 will go to 1,000, and you've missed the entire rally. And if you will open up stocks in the last 4 5 years only that have done this, they were doing nothing for 6 7 years. They were, said that they are worth only that much. They have gone and done a 10x on that. And many people have missed that out because either they were tied to the concept that this stock cannot be worth that much and hence I should not be buying it, or most of the time, even if the stock is going up, people get the recency bias that, oh, this was just 10 rupees 2 weeks back, now is at 20, why should I buy it now? I'll wait for it to come back to 12 or 13 maybe. So this creates this false belief system that I will be able to do better than the market by waiting. I will be able to time it. And this entire concept of, that I will get out, uh, once the stock has done its thing, that 99% people are not able to exit. Exiting remains the most robust part of a plan in the markets, where the best of investors get perplexed when you have to exit, because most people are looking at 20 variables basis which they will make an exit, if at all. And if three variables have gone wrong somewhere and price is starting to come down, your 17 variables are still pointing to positive things. Market share is good, management is very good. They are saying they will come back in two quarters. Some new investor is coming in, somebody important has invested in that company. All that keeps you engaged to not look at the three factors which are glaring in your face that you need to get out. And hence a very structured plan, a plan that can be quantified, needs to be made to get out of a stock that you've loved over the last many years. And you've created your vision that if this grows at 25 30% every year, in 10 years it will satisfy this goal for me. So you need to now tell me what is your strategy in terms of how you try to time the market, if at all. What is your view about this market having more legs to do a rally like that? I certainly believe that in the next 5 years, there will come a rally which we are not expecting. We could do, maybe there is a sell off for a year sometime in the middle, but then there be like a phoenix like a rise, where nobody's expecting India to take off, and you do like a Japan in India. It is very much possible that that kind of money exists in the markets, in the Indian domestic market. You will not believe the kind of money that has not yet come into the market. I mean, I meet HNIs every day who say we have been a very conventional investing family. We've always invested in real estate and gold. We've not never been able to get into equities. So this equity culture itself is expanding very, very rapidly. The kind of demographics that is coming into the workforce every year. Millions of new Indians, new jobs are getting filled by people who are graduating from colleges. And the first thing that they do, start a SIP. First thing that they do is start to save and invest. So this wave is continuing, and we really cannot fathom the kind of end result of this wave. Till when it can last, how much money can come through, what kind of returns can get generated. You can't really put any finger on any point saying that no, this is enough. Market will not go up beyond that. This is just not possible. So always try not to try and time the market, always stay in the market. You can try to create hedges across your asset class allocation, where even if there are disruptions in the market, the other parts of your asset allocation will take care of it. So for instance, I talk a lot about gold. I sincerely believe that if you have a decent and significant amount of allocation to gold, you will do really well over a period of time with just these two asset classes. So give me a shout out onto what is your plan. How are you asset allocating? What are you doing in terms of timing and your exit plans? And it will be a great discussion. Thank you so much for watching this, and I'll see you in the next one. Bye.